So there's some questions in Slido. I guess I can start on that list. And what I can do is anytime somebody has a question, you can use the chat window. That's still available to us. Anonymous was asking if I can summarize the circulation changes in Numeraire since the beginning and talk about the current float. So once upon a time, there was supposed to be 21 million Numeraire. The initial distribution sent out about 2 million tokens. Not all of it were shipped. A lot of it got locked up. So it's been hard to track over time. I've done a pretty decent job of keeping up on it. But the big change recently when they locked the total token count to 11 million was a radical shift in the possible circulation. Besides the fact that there were certain users who multi-account exploited the tournament early on, a lot of those tokens just went to the public float. A lot more tokens got locked up with either never being withdrawn or people losing their keys. Some of the tokens went to employees, and then of course there's been a lot of tokens burned. I've never kept track of how many tokens were burned. I was never very interested in that. More so I was interested to see what would happen with the investor tokens that were going out. So in terms of what the total public float is, I don't know the exact number, but it certainly isn't anything near the maximum available tokens. Can I explain more about my suggestion for burn insurance? All right. Since we're blind to the data, we have no clue how to control our model's systemic risk. So if we can't model it, then how can we be liable for it? That's kind of been my argument all along. One of the things that the team is looking for is model stability. So if they want us to be stable, then they should provide us a means to be protected from that excess volatility. That's kind of what I was arguing for. I'd say that changes in the data have definitely reduced the volatility of models over time. And I've noticed that. If you look back to when we had the 5 different tournaments, it was very difficult to have a non-burn week that was within the threshold. So they kind of moved the band. That helped a lot. But I think really the change is in the Kazutsugi data. It doesn't appear to be as volatile. When I used to train on the validation eras, I noticed that I was much more volatile. In this case, I probably am still more volatile overall, but I'm punching above my weight compared to what I used to do. I haven't really changed my model that much since Kazutsugi was released compared to previous iterations of the tournament, and I'm doing much better than I have in the past. So either they've done some smoothing of the data for us, since we can't model it, or the market conditions are more reflective of what we're training on. Either way, I think it's been a pretty good change, and I'm pleased with it. But burn insurance would step in, like if 100% of staked users all lose a lot of money, then that's clearly something that we can't model. And it doesn't seem right for us to go through a multi-burn sequence, potentially go bankrupt, if we can't model the risk ourselves. So that was the idea behind burn insurance. And they have done some things to help us in that regard. I guess it was March of last year, almost a full year ago, we went through a very, very bad burn cycle, and they stepped in and gave us a 20-week return of the burn that we lost. You had to have been staked around that time, so if you're a new user, you likely didn't get to participate in that. But I think I get my last payout next Wednesday. So they have stepped in and made it right over time. But if they do that all the time and they just step in when we burn, then what's the point of making a better model? So there is a balance, of course, that needs to happen. I think we can all acknowledge that. What top 3 tips can I share for performing well on live data? Don't forget the eras. It's time series data, right? Yeah, do something with the structure of the data to account for that. So averaging across the time series is pretty important. And you can use scikit-learn or any number of ways. You can average across different groups of eras to kind of smooth it out. But if you just pool all the time series together, you're going to have bad results. And the key here is to think about it in terms of stocks. So if we presume that an era is a month, and that within each month we have a set of stocks, and we have 120 training eras, then it's possible that we have 120 observations of a single security. And if that's true, then we need to treat that differently. We're not able to use panel methods because we can't tag the IDs, right? So it would be very bad if we had all 120 observations in a single pool, because we would overfit on the data. And that's the point of treating the eras separately. So some way of splitting that into subsets would be highly advised. So that's on eras. The second would be to not just use validation as a holdout set, to use a much larger holdout set, perhaps even half of the data. So when I started out, I didn't even touch the validation data. I just split the data right in half. And yeah, I used the first 60 eras as train data. And I found the parameters that I thought were good. And then I tested out a sample using the other half of the training data. And I saw that it was grossly overfit. And then I trained on the first 2/3 of the training data, readjusted the parameters to make sure I wasn't overfit. And I iterated that way so that I can add just a bit more each time. And only until I thought I had it did I actually take a peek at the validation data, and I verified that it wasn't too overfit. And how do you know that in this tournament? I mean, it's next to impossible to tell what's going on, right? So that would be my third tip, would to look at the correlation scores themselves. I found over time that between 3.6 and 4.4% correlation is going to turn out to be pretty well on live data. Anything over about 4.8, you're probably overfit. You're not likely to have good results. I can't tell you why that's the case. It's just something I've observed over time, and it's something I tell my students. And that's been working out pretty well. One of my students is in the top 200 right now. So clearly that's been pretty good advice. It's working for him. And that's what I would tell pretty much everybody else to do too. Can I prove Numerai can utilize high MMC predictions in ways that add value to the hedge fund without hand waving? Apparently I'm a hand talker, so ha, I don't care. Well, no, because they're taking a bootstrap method to calculate MMC. So they're doing repeated sampling to determine what it would be. If we had all the models in there, it wouldn't pick clusters. It would pick individual models. It would find an efficient frontier, and anybody's model that created a portfolio that fell on the efficient frontier would be probably selected. And in all likelihood, there'd be maybe 5 or 6 people that would actually contribute to the meta model. That's not good, and that's why I argued that similarity isn't a bad thing. If anything, it boosts the significance of that modeling technique. So if I was the only person that had a model in a cluster and it had a very high MMC, that doesn't mean it's any good. It just means it's not correlated. But if I exist in the cluster, such as all the XGBoost models, which I think my model does, and that's fine, but I'm kind of validating that the methodology works. And that's sort of what I'm arguing for here with bootstrapping. I think it's important that we have 30, 50, 150, 200 people all using the same methodology but slightly different, because the benefit of that is that we're independently validating the methodology and sticking on it separately. I think that's very important. Without that, we would just have a hodgepodge of users that randomly do well at different times. It's the sum of all the parts that matters the most. And so that's why I think the way Mike set up MMC now is actually very robust, but it does not give us a direct approximation of what our model is actually doing for the MMC. It's just an estimate. But that's fine, because like I said, we're all benefiting the meta model in a sum of the parts kind of way. Can you explain what you think Numerai assets are, market, investment type, etc., by taking into what little we know over time? I'm not really sure I get that, but I'm going to try. So what do I think they're trading? Well, they've said that they're trading global equities. That's been public for a very long time. So I don't think that's anything new. We know it's a long time frame because our evaluation window is so long. So it's not like we're doing market microstructure. If that were the case, we would need to upload a model that they could ping every second or so. And we're not even close to that. Can you imagine if we had that much training data? I actually probably wouldn't participate. I don't think any of us individually have enough computing power to handle that kind of data. So yeah, it's just global equity. One of the things about that is I've long suspected that the models are long biased. Richard has assured me in person, in chat, and multiple times that that's not the case, that the data is not long biased. I still don't know if I agree. The correlation over time for me is too strong. I've just noticed when the market does well that we do well. But the recent volatility over the past, say, 10 trading days has actually made me wonder if I've been wrong all this time and Richard's been right, because I'm up almost 20%, and I figured I'd be down about that much. So it's very interesting to see how this is playing out. I mean, the US markets were down 10%. I assumed that all of us would be, ripping our hair out thinking that our stakes were going to get completely burned. But actually I'm up on all that trading. So it's very, very interesting. So what does that infer for us? I don't know, except that the data in its current form seems to be pretty decent because the term has been fairly profitable for me. But I have been staking for a long time, and so I'm earning the bonus every trading day. And I think that's the key for profitability for users, every trading day. Any intuition why regression seems to work better than logistic targets or multi-class classification? I don't know, that's how I set up the data. No clue. I'm just glad that it's a clean data set, and iterating on it is pretty straightforward. Why would regression work better than classification? Well, let me just think on that a bit. I suppose in the grand scheme of things, it wouldn't really matter, because we had a classification target before and my models performed pretty similarly. I guess in the end, what they're really looking for is for us to put a number on it, right? A continuous measure of what we think the stock will do. I've long suspected that the target, or a value of 1 represented to buy the stock, and a 0 would be to short it. And so the closer to 1 it is, the more confidence your model has in that being the case. But I have no idea. Correlation seems to be working pretty well. I mean, there it is. Like 33. I mean, we're all doing pretty good. I'm interested to see what the results look like today. Is there any promising field theory, algorithm, or approach you think will be useful for Numerai-like problems? Well, I study finance, so I don't study algorithms or any kind of, econometric solutions. And what we do in empirical research isn't anything close to what machine learning is doing. Because we're using panel methods where we know the IDs. This is a very unique data set. I don't know that empirical methods would work here. But dynamic portfolio theory is something that's very interesting. It's not at all applicable to the tournament, but the idea that we're saying that today's estimate of the market is predictive for the future is, I think, a little bit like nonsense, right? We don't know what's going to happen tomorrow, and it's very evident in all the literature in finance. It's a fool's errand to try to say that we can predict with accuracy what's going to happen. And thank goodness that's the case, because that gives me a lot of job security as I look for a job at a research institution. So I'm fine with that. The point is to research market efficiency, I think, and make sure that when countries, individuals, firms try to access the capital market, that they can do so and receive a fair price. So as long as that is what we're researching, I'm fine with that. This drive to find the edge is very difficult, and I think that's why this is the most difficult machine learning challenge in the world, because we're all fighting for a 0.5 to 1% edge that disappears frequently, and thus our models should change over time. It'll be very interesting how that plays out, and even more so, predicting on a longer time frame is even harder. And then to do it on international equities, forget about it. So that's what attracted me to this tournament in particular, was that I knew it was equities underlying this obfuscated data. It's just very fascinating, and I'm sure that's why a lot of us are here. It's a very interesting challenge. But no, there isn't really anything new coming out. I mean, we haven't had new asset classes in some time in finance. I mean, geez, cryptocurrency is one of the newer asset classes that we've had since what, the 1950s? I mean, you can argue that the derivatives markets, each new contract is a new asset, but it's still a rather traditional form, right? Because there's still underlying intrinsic value, whereas we don't know that cryptocurrency has any intrinsic value. So it's just an exciting time to study finance. That's why I'm sticking with it, and I hope to focus more on fintech as time goes on. Our current research looks at crowdfunding, bank distress, and the actual implications of bank distress. And so any topic that falls in that area is very interesting to me. And yeah, I really haven't seen anything that would be of benefit to the tournament in terms of my research area. Fintech in general is just still so new that the research isn't very good in my opinion, and we'll see as that goes on. Since we know little about the assets or how predictions are utilized, why do you think there are historical limits on the hedge fund's earning capacity? Well, are we talking about hedge funds in general or this hedge fund? Well, one of the limits for hedge funds is scale, right? If you find an edge, trading on it collapses that edge because you're making it more efficient. When you find an edge in finance, you are therefore finding something that is an inefficiency in the market. And by trading on that inefficiency, you are closing the profitability of it. So one of the biggest problems for hedge funds is finding a strategy that scales. And that's absolutely true for Numerai as well. They're a hedge fund. So anything that happens to other hedge funds is also applicable to them. I would say that one of the challenges for Numerai is going to be to have enough stability in their investment thesis to justify getting assets under management. Anytime they change their strategy, they have to sell it to their investors, and that's very hard. I think they've been pretty stable because the time frame that we're dealing with has been consistent. We've always had a 1 week lag in results, and it's always been a 1 month time frame. So in that respect, I think they have a lot of stability. They also have a lot of data. It's been, geez, are we coming up on the 4th year? Yeah, we are actually. When did I sign up? Does that still show? I thought it did. Yeah, so April 26th of 2016. Yeah, oh my gosh, that's next month. That's amazing. So they're going to have 4 years of data. That's a lot. I would imagine that they should see some pretty rapid growth after that. So the limits on hedge funds' earning capacity is the scale of the strategy that they're trying to deploy, and that's not easy. That's not easy, and nobody knows when that signal is going to collapse. Somebody else may stumble into the signal at another hedge fund and trade on it. That's a risk. And regime change is a thing too, right? So if a security law changes somewhere that affects the way their signal shows up in the data, that could also cause a problem. None of this can be known in advance, but that's why there's so much training features in the data. Because if one of the, let's say, I don't know this to be true and I've never been told, I'm speculating here, but let's just say one of the columns represents an exposure to a market risk factor of some kind. Well, if that column all of a sudden gets traded on by too many hedge funds, it will evaporate and won't have any signal. And if we're overloaded on that column, we're going to start to get very bad correlation scores because it won't be profitable. And so that's why it's very important not to overfit on any single column of the data. So I think Richard has said that they plan on adding more columns over time, but we won't be required to train on them because the current data still works. So I'm interested to see how that plays out too. And the final question, how much does Numeraire's price volatility affect our model's effective Sharpe ratio? Well, that's a problem, right? There isn't really an easy answer to that. I've discussed in chat for a long time that there's a two-step investment process for us. First, we have to buy Numeraire. So if we buy 100 Numeraire at $10 each, we have a $1,000 investment, fiat equivalent. If we then stake on that model, from our perspective and from our tax perspective, we're concerned that our $1,000 earns profit. If the value of Numeraire declines 50%, but our model earns 10% on its Numeraire, we've still lost a significant amount of money. So that is a risk. However, I would expect anything in the crypto space to give crypto-like returns. So hear me out. Equities historically return, what, 8%, 12%, depending on who you ask, up to 18% in small caps if you add internationals in it. So if my safe, sorry, I got a phone call coming in, let me reject that. If I have a safe investment in equities that will garner, let's just call it 20%, which is ridiculous, it's not that high, but let's just call it 20%. Then I need to exceed that return if I'm going to move into crypto and then also be exposed to equities. Crypto-like returns, I would say I want to at least double my money. And then what time frame? Well, that's subjective, but I would want to at least double my money once a year. So I want my $1,000 to turn into $2,000. On average, I would expect that, which means let's back that into an average performing model. So an average performing model in the tournament right now for how many staked accounts are there? Let's take a look. Let's look at it. So we have 62,000 Numeraire at risk right now, right? How many staked models are there? By the way, don't forget about the chat window. If you guys want to ask questions, go ahead. Oh, there's one of my students. There's one of my students. Oh, there's one of my students. So good, they're still in it. There's one of my students. Anyway, let's keep going. All right, 480 stake models. So somebody in the middle at rank 240, I would say, in this zone here, these people should be profitable on average in a given year. And they should, I believe, this is my opinion, that they should be able to earn crypto-like returns for being average. The people at the top, myself included, certainly deserve much higher than that. When I did simulations of my model's returns, it's possible that I could see a 3x to 4x return over the course of a year based on the bonus structure. But that does have a limited bound on the bonus payout. I didn't model that into my simulations. But how does that affect us? Like I said, if the token value goes down because of somebody moving on the market, that affects our return in fiat equivalency. And that's where our risk lies. How do we mitigate that? I have not figured that out. I've been thinking about that for a very long time. But the best thing that can be done, burn insurance is one of them. Some way of solving that problem, but the other would be to just have higher payouts. I think it's warranted. What we're doing is very difficult. But at the same time, I don't think somebody who just fires up the example predictions, submits them, and then stakes $10,000 on it deserves the double because they were able to open a Google Colab sheet and hit run all. You know, I think there should be some effort tied to it. And therein lies the perpetual feedback loop that we're stuck in. So, you know, how do we reduce volatility, encourage participation, and make payout profitable, but then also make it Sybil resistant? That's the most vexing challenge I think the team faces. And I give them a lot of credit for putting up with us arguing with them all the time in chat. But We'll see.